Convertible bonds are corporate bonds which investors can convert to a set number of shares of the issuer's common shares. As a result of its potential for growth, the coupon tends to be relatively lower than that offered for a similar non-convertible bond. The share price at which a convertible bond can be exchanged for shares is called the conversion price. The conversion ratio can be found by dividing the par value of the bond, typically $1,000, by the conversion price. For example, if a convertible bond has a current price of $40, the conversion ratio is 25:1. The bond could be converted to common share once the underlying share price reaches $40. The convertible bondholder will receive 25 shares. These bonds typically have lower interest rates, which is an attraction to corporations that wish to raise funds. When corporate bonds are converted to common shares, the issuer ceases paying fixed interest, thus reducing its debt. Another advantage of issuing convertible bonds instead of common shares is that doing so does not instantly increase the issuer's number of outstanding shares, which would otherwise reduce earnings per share. This benefit can also be a double-edged sword. If a sizable number of simultaneous conversions take place, they could impact on earnings per share and voting rights, which could effectively alter company control. It is important to note that bondholders that have not initiated a conversion maintain their precedence over common shareholders in the event of liquidation. A convertible bond continues to pay a fixed rate of interest, and the par value is returned at maturity, except in cases of default. These interest payments have a higher priority of payment over dividend payments, which shareholders may be entitled to. A convertible bond is not entirely immune to volatility that may be experienced in the market in general or by its underlying share. Instead, it may be more susceptible to this market risk than comparable non-convertible bonds. Should the investor decide to make a conversion to common share, such conversion is not deemed to be buying and selling from a taxation perspective.